All right. Very cool. So I've got Kim Hubbard with me today, which is, I'm so excited to have her because she has so much experience and knowledge about investing in property. And if you could just tell us a little bit about who you are and what you do, Kim, that would be awesome.
Yeah, you bet. Thanks so much for having me. I'm super excited to be on. So I am Kim Hubbard. I'm with Merchants Mortgage, and Merchants Mortgage is a local mortgage company here in Denver. We've been in Denver since 1961. I've been with the company for 23 years, so I've been there a long time. Obviously, I love it. It's a great company. And we only specialize in working with real estate investors. So I don't do any homeowner loans. We strictly do fix and flips, and I have clients that also fix and hold properties where they will use our short-term loan to buy the property and fix it up and then refinance it into other lenders' long-term financing. And they do that two-step process because we require a lot less down payment than a conventional investment property loan does. So that's why we're also a good option for clients that fix and hold. And we also do ground up construction loans. I'm looking at a property right now for a client. I had the pleasure of working with Jennifer. She's awesome. So I love teaming with people that are successful in this business. And we also do not only residential, but we also do multifamily. And so multifamily would be anything 5+ units. And we are headquartered here in Denver. In Denver, we pretty much lend up and down the Front Range. So anything between Pueblo and Fort Collins. We don't do a lot in the mountains. We are in 10 different states. So if you're looking at some other states, I'm not national, but we are in 10 states, and I might be able to help you out if you're looking at properties elsewhere. I am the sales manager at Merchants, but I also work directly with clients to originate loans. So I've got a great staff behind me and just a lot of experience in this particular niche.
Okay. Well, awesome. Well, thank you for that introduction, and we'll definitely go through some of those details. I'm Jenny Morissette. I've been in the business since 2004, since January, and I'm a Colorado native, so really invested in people that live here and properties. I've worked all over the metro area, but I definitely prefer kind of the southeast part of town, and have some different designations and things. Basically, a lot of experience and a lot of mistakes over the years and things that I've done with my own properties that hopefully I won't repeat. But like you said, Kim, I recently purchased a fix and hold, and that was such a great experience with you. So thank you for that.
Thank you.
Yeah, we've done some fix and flips as well. So reasons to buy an investment property. I mean, I think, most people realize the benefits to that. Obviously, having multiple streams of income, protection, because if some of your investments aren't doing so good over the long term, real estate has always been a great investment, and that return on investment has been solid. Do you have anything to say about that, Kim, or reasons why?
Just how strong this market has proved to be. Certainly, April was a much slower month for us all, but looking at the statistics, values did not decrease or barely at all between March and April here in this Denver market. And that just is the factor of how low the inventory still is. And in fact, average and median prices were up in April compared to last April. So, this market is still going strong, both in not only the sales side of things, but in the rental market because of the low inventory. It's just amazing. We all complained about the lack of inventory, but it's been our saving grace with the fact that Denver is so popular to live in and the low interest rates.
Right. Yeah, I should have actually included that sheet. the Federal Housing and Finance Administration, they put out a quarterly report, and Colorado consistently does really, really well on the level of appreciation. And I think since 1991, we've had over 400% appreciation. So that's phenomenal. There's hardly any other states that have that high of a return on property or appreciation values. So of course, the steps to buying and being successful at an investment property are, you definitely have to start with a clear financial picture of where you're at and where you need to be in order to make that happen. Selecting a realtor that is experienced and can help you in that process, and then of course getting pre-approved for a mortgage. After that really is when you can start shopping, so to speak, and searching for the right property and making sure to check that return on investment, which we'll go over. And then of course completing the purchase and deciding who's going to manage the property, who's going to take care of that. Are you going to do it, or are you going to hire somebody to do it? So Kim, one of the questions I had for you is what does the pre-approval process look like with a lender like you, where it's more of hard money versus a traditional a lender?
Sure, yeah. So definitely, like Jenny said, you want to get pre-approved before you're out there putting in contracts. And with a lender like us that is considered more hard money, we're going to not require as much documentation as a conventional lender does. We are going to have you do an online loan application, and it's like a condensed version of what you would complete for a conventional lender. So it's not as intensive, but it gives us all of the key information that we need to make a loan decision. Also on our loans, the borrower's credit is important, so we will be pulling a credit report. We're typically looking for a credit score of at least 680 for our lowest down payment program. And we're going to look at the borrower's liquidity. So we're going to want things like your most recent statement for checking, savings, stock accounts, 401ks. If you have a home equity line, we'd like a copy of that because that will factor into the underwriting decision. We personally, as a company, on this type of short-term investment property fix and flip loan, do not have a debt to income ratio requirement. So that makes it a lot easier for investors to qualify. If you do have income, we'll go ahead and take a tax return or a pay stub or a W-2 or 1099 for the file, just to show kind of as an additional strength that you have income. But again, we really don't have a debt to income requirement. So just plan on the application, your liquid asset statements, and then we're also going to want to know your experience as an investor. So have you done a fix and flip before? Have you owned a rental property? And if you don't, we do work with new investors, but we are going to want to know, like, are you working with an experienced agent like Jenny that has done fix and flips, that can guide you through the process? Do you have a good contractor? So we're going to want to know, if you're a brand new investor, what do you bring to the table to show that you can be successful as a real estate investor? And once we have the information from you, it usually just takes us a day to get you pre-approved, and then we're able to give you that pre-approval letter, so your agent can have that when you're putting in your offers. And we can close very quickly as well, usually within a week or less.
Wow. So yeah, that's definitely much quicker than a traditional 30-day close. So that's awesome. So, obviously some options for down payment is, of course, if you're paying cash, that's always going to put you in the top negotiating position. But most people, a lot of people don't have $200,000 or $300,000. So the options then would be to do a non-owner occupied loan, where you're going to have to, that's with a traditional lender, where you're looking at 20 to 25% down. I'm going to skip over that third bullet point because I want to talk to you about that, Kim. But the other option would be, like, if you were going to buy a property to use as a second or a vacation home, which might be an option if you want to buy a piece of investment property but also be able to use it, which is kind of a cool idea. So, and with that, you only have to have 10% down. Now with your program, Kim, the other day you were saying 10% down for the purchase price and then 10% down for fix-up costs. Could you like maybe give us a scenario on that?
Yeah, sure. So, yes, we are able to lend 90% of the purchase price and 90% of the repairs. So we would get the repair budget from the borrower. We will review that for reasonableness, and it will also factor into the appraised value. So for example, if you were buying a property where the purchase price was, let's say, 300,000, your 10% down of the 300,000 would be 30,000. And then if your fix up were 50,000 total, we would lend you 90% of that, and you would just come in with the other 10%, which is the 5,000. So in that case, your 10% of purchase price and 10% of repairs would be 35,000. We're lending you the other 90. And then we do compare the loan amount to the after repair value appraisal that we'll get. And we don't want that ratio to be any more than 75%, because it's got to make sense that you can make money as a flip, or that if you decided to or needed to hold on to it as a rental, that you would be at the right loan to value position to get refinanced into long-term financing. And on conventional refinances on investment properties, they're looking for you generally to stay at a 75% loan to value. So that's the position that we want to put you in as well, whether you're going to fix and sell it or fix and refinance it.
Okay. Okay, well, great. And again, you know, qualifying with a traditional lender is going to take a little bit more work in terms of showing that you have the cash reserves and income and source of down payment. It's a little more intense, I feel like.
For sure. Yeah.
Yeah. I mean, and then again, you talked about debt to income ratios and not being as big of a deal as it is with a traditional lender. Do you want to just talk about that briefly, what debt to income ratio is, since people might not know?
Yeah, sure. That's a really good point. I throw out these terms and it's good to have them explained. So yeah, you'll hear DTI, which is debt to income ratio. And that's just where the lender is comparing your monthly payments to your monthly income. And so the things that they're going to include in your monthly payments are going to be your own home mortgage. They're going to include any portion of other properties that you own, like rental properties. If they're not covered by rental income, they'll count that payment against you. And then anything like car loans, student loans, monthly credit card payments, that will be considered your monthly debt payments. They're not going to include things like your groceries and your electricity. That's not factored in. And then they're going to use your monthly income, which depending on the lender, depending on the program, oftentimes that will be like an average of your last 2 years adjusted gross income, which is always harder for a self-employed person to qualify for, just because they do take so many business expense reductions, and oftentimes show very low adjusted gross income. So it can be harder, particularly for self-employed people, if they're not, showing good adjusted gross income on their tax returns, to be able to qualify. Whereas hard money like ours, we really don't look at the debt to income. We look more at your liquidity and your credit. That said, if you do plan to use our loan and then refinance into conventional financing for a rental property, we will want to make sure that you have qualified with that takeout lender, because our requirements are easier, but you still have to qualify for the long-term financing if you're going to refinance out into long-term financing. So we want to make sure, we set you up to succeed and have you pre-approved on the long-term financing as well, if it's going to be a rental property.
Definitely. Okay, so with that, how long can you use your financing for? Is it like, how long is a loan typical? with you?
Sure, yeah. So since we are dealing with fix and flips, it's a 6-month loan, but it does have an automatic 6-month extension. So there is a safety net there. Not a lot of our clients need to go into the extension period, or if they do, it's usually only for a month or two. But it is there, and you do incur a monthly extension fee if you go past month 6. But that fee is added on to the payoff at the end of your loan. So it doesn't change your monthly payment if you go into the extension period, but you would have an extension fee on your payoff. And that monthly fee is 1/3% on your loan amount. So that's how that works. But the loan can go up to a year if you use all of the extension period. So
Okay,
again, since it's for flips, it's just designed for short-term financing.
right. Okay. So a big one is, how do you come up with a down payment? So obviously checking savings works. One thing that has become popular is equity from your current home using like a HELOC, a home equity line of credit. Cash out refinancing, I don't think is really possible right now just because of the COVID changes in lending. Have you heard anything about that, Kim?
I think you're right, Jenny. I don't think that there's a lot of cash out refinancing going on at the moment. We'll see as things continue to settle down. They might just do it at much lower loan to values. So you'd have to have a lot of equity in the property to get cash out.
Mhm.
But yeah, right now it's pretty much rate and term refinances. You're
Right.
right.
Right. And even with the home equity line of credit, I think you can only go to like a 75% max of or maybe a little higher than that, but they are definitely being a little more conservative
Sure.
of your max value. So, if we were looking at your house being worth 400,000, then the max amount or um, you would not be able to loan more than 300,000 for the house. So if you had, you only owed 200,000, that would give you $100,000 to be able to put down on another property. So, what have you heard of people using their retirement accounts for down payments or property investing?
Yeah, and right now I've had a couple of clients, especially since there's no penalty on pulling out of the 401k at
Hmm.
the current moment. The last couple of clients that I did fix and flip loans for actually used their 401k. I've also had clients use the self-directed IRA. And in that case, they need a non-recourse loan to get the benefits of investing in the self-directed IRA. And a non-recourse loan means that you're not personally guaranteeing the loan. And we do those types of non-recourse loans as well for clients that want to invest through their self-directed IRA, but it is considered riskier for the lender because you are not personally guaranteeing the loan. So we do require more down payment in that situation than we would if you're doing just a normal loan, not through your self-directed IRA where you are personally guaranteeing the loan. Another couple of options on down payment sources, at least as far as we're concerned on the fix and flip, is we do have clients that partner with other people and the other partners bring in the cash or bring in some secondary financing through lending out of their own IRA to the entity that's buying the property. We also do something that's called cross collateralization. And it's not a home equity line of credit, but it's a similar concept of lending you money against another property. If you've got a low loan to value on that property already, we might be able to use equity in one of your other properties as the down payment for the fix and flip.
Oh,
It's
cool.
not a line of credit. It is just attached to that one fix and flip that you do. And then when you pay us off, that goes away. It doesn't stay out as a line of credit. So I always recommend for people that can get a line of credit to go ahead and do that because that line of credit stays in place. You don't have to take out a new loan for it each time. And because home equity line of credits still are so cheap, the rates are so low. But if that's not an option for a client, maybe they don't have the right debt to income ratio to qualify for the home equity line of credit, then we could look at cross collateralization. So that's an option too.
Wow, that sounds great. A lot of different options. Do you know, so is there a max on what people can pull out of their 401k? And you said they're not getting penalized on that right now. Is that just a COVID thing or?
It's a COVID thing, yeah. And, I'm not an accountant and, probably not entirely up to speed on all of that stuff. So I probably shouldn't opine on that, but I just know, the last couple of clients that I did loans for pulled it out of their 401k.
Okay, so it might be something to at least look into with your CPA then. Cool. Okay. So then, of course, once you get pre-approved, you're ready to go. And again, having that strong pre-approval, especially with a program like yours, Kim, where you can close in a week to 10 days, makes you just as attractive as an all cash buyer. So that's awesome. Love that.
Absolutely. That's why we've got that team to be able to close quickly, because you have to be able to compete against cash. And we know, we can't take 30, 45 days like a traditional mortgage. So yeah, cash is king, and we've got to be able to react like cash as well.
Right. Yep. Okay, so then obviously the next part is searching for properties. So, price is a factor, condition, knowing how much you're going to have to put into it. Do a lot of your clients use like any sort of software to estimate that, or what do you recommend for a first-time investor with,
Sure.
figuring out
Yeah.
the cost of condition of repairs?
Sure. Well, we do now, it's not going to tell you the numbers to put in it, but we do have like our own spreadsheet that we like and pretty much require our borrowers to use when they are filling out their estimated repairs, just because it's got the right amount of detail in it, and it kind of takes you from the outside of the house and through each room and makes you really think about what's needed for each room and each area. And then, of course, we recommend that they get at least 3 bids. They can also price things out through Home Depot's program and whatnot. And just, as you gain more experience, as then you really know a lot of that stuff just off the top of your head. You can look at it and say, okay, that roof needs to be replaced. That's, a $15,000 roof. This kitchen is going to take, depending on the property, it's going to take 30 grand to get it up to snuff. So we see a lot of, experienced investors really just being able to get it really pretty darn close just based on their experience. But certainly when you're starting, get the 3 bids, start learning how to price it out through Home Depot at a minimum. And, absolutely. And we require this even for experienced investors to have at least a 10% contingency in there, where you add up your total budget and then you add another 10% on top of that for, the things that you might have missed or the things that you go overboard on.
Right. Yeah. So one thing I did is before I purchased the property, and I know some people will actually, they have a trusted inspector or contractor that will go look at the properties with them, so that they can tell right then and there, okay, this is going to cost, 50,000 to flip or whatever the case might be.
That's the perfect advice. Yeah.
Yeah. So that really saves some time to be able to put together that worksheet. And I think Brenton had a question about, is that worksheet something that you could share, or is there something like it that we could share?
Oh, absolutely. So it is on our website under a tab called Loan Process. And our website is Merchants with an S, MERCHANTS, and then the abbreviation for mortgage. So M is in Mary, T is in Tom, G is in George.com. So merchantsmtg.com under the loan process, and then it's got like the repair budget as a document within there. Or certainly we can get my information out to you and you can contact me directly. I'm happy to help in any event that I can and get you the most information possible.
Awesome. Yeah. So, and then from a real estate standpoint, they always say location, 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 which is totally true with investment properties. Good school districts are going to be something you want to look for, but also areas that attract people who maybe need or want to be there on a temporary basis, or, for instance, in Aurora, but we have Buckley Air Force Base where, a lot of people are just stationed for a year or two or sometimes more, but they don't want to necessarily buy a place. Oh, there we go. You posted the website already.
Yeah, thank you, Bridget. Really appreciate that. Good job.
Awesome. So yeah, definitely just looking at locations in terms of who's going to want to rent this property, assuming you're going to do a fix and hold for that investment. So, and then of course, more bedrooms and bathrooms equals higher rent. Right now, 2-bedroom condos are going from anywhere from 12 to 1,500, depending on where and how nice. And then when you get into single families, of course, that goes up. And also, having a property manager in your database that you can call and ask questions of is always nice. But there's also a lot of online resources like rentometer.com where you can type in an address. I think they limit you to like 5 addresses. But they'll give you an estimated rent. And then also Zillow is, of course, something that you can use to estimate rents as well. But I definitely don't think that condos or townhomes should be overlooked. I mean, single family homes, yes, down the road in terms of return on investment are going to be higher, but you could also make some good money on condos and townhomes and sometimes flip those quicker.
Absolutely. And I do have a lot of clients that use condos as, fix and holds as well, obviously for the rental income. And, it's great because, they're much easier to wrap your arms around in terms of what the value is because, one condo unit's like the other. So the sales tell you rather than properties that maybe don't have a lot of other similar properties to them when you're trying to figure out values, when you're trying to figure out rents. Condos pretty much rent for the same things in the same unit area. And I use Rent-A-Meter a lot too, Jenny, so I'm so glad you threw that out there. And I always think it's best, maybe Jenny, you have different advice, but you kind of want to be in the middle of the road on what you're charging on rents. You don't want to be too low or too high. It's always good to be in the middle.
Yeah, you definitely don't want to overestimate that, overestimate your rents because it can really mess up your return on investment. So speaking of which, how do we do that? So we want to take your annual rental income, subtract out your principal, interest, taxes, insurance, and HOA. Factor in a vacancy rate, property management costs if you're going to be using a property manager, and then having kind of a repair or reserve fund. So let's just take a look at one of these here. I think, let me go back. I think somebody up here had, oh no, I stopped the share. Let me go back. Somebody had a question and I got distracted. Rent-O-Meter. Okay, thank you, Kim. Okay, so if we go back here, yeah, this is the first page. Okay, so this is an example of a property that was on the market. The list price was $225. I mean, hopefully you can get it for less. But the market under 250, at least, the properties that are in MLS are typically going for asking price. So 20% down payment would be $45,000. Of course, this would be different with your program. Using 10% down, you'd be looking at $22,500. And then, but in a case like this where it's already fixed up, you probably would just go with traditional financing. So that initial investment would be the $49,600, including your closing costs. You have that loan. Now interest rates for traditional financing for non-owner occupant properties, which are investment properties, is a little higher. And right now it might even be a little higher than 4.5%. I think I have one at 5%. So once we break that down, that's how we figure out your monthly cash flow, total expenses minus your income. And then we figure out, okay, how much debt reduction are you going to have from paying the mortgage over the first year, tax savings, and again, you'd have to check with your CPA for numbers on this to be exact. And then appreciation. So I use a pretty low rate of appreciation just to be more on the conservative side of 2% per year. Hopefully it'll, appreciate like it has been like closer to 5%. But so if we add all of those numbers up together, you can be as high as an 18% return. And then once you have the property paid for free and clear, you have almost $20,000 a year in income. And also by then, rents will probably be a lot higher, as will the property values. So definitely worth it to purchase an investment property. Anything you have to say on that, Kim, or is there any charts or anything that you recommend to calculate return on investment?
No, I mean, you laid it out exactly right. So I don't think I could do a better job than you did. This is an excellent resource. And I would just add, and you may be getting to this, but so much about cash flow is also making sure that you or your property manager are doing a good job of vetting the tenants. That cash flow is dependent on you keeping good tenants in there so that you're not having the lags of having to repair the property again to get a new tenant in. And I mean, it's kind of hard during a pandemic to know who's going to lose their job and who's not, but definitely checking the credit and checking with past landlords and getting their feedback on how the person was as a renter, and then treating a good renter well, so that they want to stay.
Right. Yeah, it's definitely, obviously this pandemic has caused a lot of situations that none of us really could ever anticipate or expect. One of them that made me really nervous because one of my properties went vacant right at the beginning of this whole thing, was just finding somebody, especially with the temporary hold on evictions and things like that if people don't pay rent. So yeah, so that can be a little nerve-wracking.
Did you find another tenant? What was your experience? Yeah.
Yep, a lot of interest, a lot of people that were still, wanting to move and get into a place despite the circumstances. So that was great.
Yeah, I feel like if you're in an area that's popular for rentals, then you're going to be able to get another renter if it's in a popular, like you said, near schools or near a light rail or the Air Force Base. I mean, your odds of finding somebody else are better.
Right.
If it's in a popular rental area. Yeah.
Right. Yep, definitely. Okay, now one question I have for you, Kim, I don't actually remember this. With your program, when you're doing the fix and holds mortgage, do you do an appraisal? You do, right?
We do, yes. So we do get an after repair value appraisal estimate based on what the client is going to do to the property. So we have them complete that budget form that we were talking about earlier. And we have the appraiser give us feedback on that budget when they're out there at the property to tell us whether or not they think that that budget is adequate for the property.
Ah.
And if it's not, we're going to talk to the client and get it worked out mutually. If the client has missed an item that the appraiser really feels needs to be repaired, we'll discuss that with the client and get it worked out. And so, yes, we are getting an after repair value estimate, and we're able to get our appraisals really quickly. We have a team of appraisers. They're all separate. They're not part of the same company. But we're fortunate that we've worked with them for like 15 to 18 years. They've all done flips themselves. They totally get the process. They've been in thousands of properties. They know Denver like the back of their hands. And we are not a conventional loan company, so we don't have to go through one of those appraisal management systems. We're actually able to choose the appraiser, and you as the client or you as the agent, Jenny, are able to talk directly with the appraiser. They do get that budget, and there are some questions that we have you answer about what you're going to do to the property. But a lot of times it's just better if you're out there with the appraiser and you're pointing out to them what you're going to do to improve the property. So it's nice that we're able to have that direct interaction with the appraiser, and they're able to turn them around for us within like 3-4 days. So we'll get that value back to you quickly, and you'll get to be able to see what comparable sales that they used in coming up with their value.
Right. That's awesome. And then, of course, I always recommend doing an inspection just because you just never know what stuff might come up. And it's better to know before you purchase the property. Even if you're purchasing it as is, I still recommend doing an inspection, a thorough inspection. So, okay, so managing a property, obviously there's a lot that goes into this. You have to have the ability to show the property, qualified tenants, administer the lease agreement. If you're going to be doing the maintenance and repairs, how are you going to handle that? There's a lot of laws and fair housing requirements that you need to stay up on. Handle evictions when needed, and then financial statements for tax purposes. So obviously a property manager is going to do all of this stuff for you, but there are a lot of tools out there to where you can do it yourself as well. One of them that I came across recently is called Rently, and that one is really cool because they provide you with a Sentry lockbox where you put the key in there, and the prospect calls the 1-800 number, says, hey, I want to view this property. They have to send a copy of their driver's license and 99 cents, and then they get the code that's good for like an hour for them to get into the property. So they essentially show the property themselves, which worked out really great for this COVID situation.
Yeah.
Yeah, and they also, as part of the cost, they broadcast the rental listing to multiple websites. So I didn't even have to do any sort of advertising at all. So that was really cool. As far as qualifying, if you decide to do it yourself, there's also a lot of services locally and online that will do background checks and employment checks and credit checks. Obviously, like you said, you definitely want to vet people pretty well so that you're choosing the right tenant for the property. And then as far as the lease agreement and staying current on laws and things like that, there are attorneys out there that will offer what they call landlord packages, to where you just pay them a flat fee and they kind of look over your agreement and, let you know if you're handling it correctly, and the same with evictions. So either way, you can do it yourself or contract out. Typically, property management companies take 10% of the collected rent every month. Sometimes you can find a company for a little less. I don't know, do you have any recommendations either way on that?
I was actually going to ask you, Jenny, with your experience, and I'm sure it's different for everybody, but what do you feel is like a number of properties where it definitely pays to be having the professional property manager versus trying to do it yourself? And I guess, part of that too is like, how spread out are your properties? It might be kind of hard if they're really spread out. It's probably just better to have the property manager, but if they're kind of all in one area, what is just your personal opinion on when it's good to hire it out professionally?
So I
put
would
you on the
say,
spot, didn't I? But you have so much experience.
So here's the thing, doing it yourself is obviously going to be the more high stress route.
Sure, of course.
Even though I've done it myself, and I did it myself on this last go around, oh my gosh, there were so many nights where I was like, oh my God, am I doing this right? And am I going to find somebody? And you still have those thoughts even when you use a property manager. But the nice thing is it's on them, and the pressure is on them basically. But it is nice to save that 10% too. So I think it kind of depends. I will tell you that one of my properties was the tenant was my daughter, and I definitely used a property manager for that because I knew I wouldn't be able to evict her if she couldn't
evict
pay.
your daughter. I was going to say that too, like, if you have a tough time, which I do, of, being the heavy hand, it's better to hire it out.
Yeah, exactly. So I think it just depends on, if you feel like you have the grit and the ability to evict somebody if you have to, then go for it. But just make sure you do it right. These are some of my recommended people on here. We've got attorneys and property managers, and I can definitely send you that information. But yeah, so just wanted to kind of open it up for questions, if anybody has any questions, and see where we want to go from there. So any questions, anybody? No?
You were so thorough.
Oh, let me see. Do I have to unmute you?
Oh.
Maybe, I don't know.
Yeah.
Oh, there we go.
Kim, you had made a comment that you only need a credit report of like 680. That seems kind of low.
Well, a 680, it's not off the charts, but generally people that do have a 680 have pretty good credit. They don't have generally like bankruptcies or a lot of recent late payments or anything like that. And even though that's our minimum, a lot of our clients just happen to have higher credit than that. But that is just our minimum for our 90% program. Certainly if the client has lower credit than that, we can still look at it, but it will require them to have more down payment. And we're not really a lender for individuals that have poor credit. That would have to be more traditional type of hard money where they're not really even looking at the client's credit score at all. They're just looking at the property. But with those types of loans, you're going to get into much higher interest rates than you do on our type of hard money where we are, looking for certain qualifications from the borrower.
Okay, well, it just seemed low to me, so I was like, really?
Well, that's because you're stellar.
Yeah. So, Kim, one thing that I was going to ask you, with your experience and the amount of people that you interact with, what are your predictions for the real estate market? Where do you think things are going to go after everything that's just happened?
Settle down, sure. Well, I'm not an economist, I'll say that, and I'm not a politician, certainly, but I'm not a scientist. So some of the things are just obviously like my own personal feelings, but just seeing how things have rapidly already started turning around in the last few days once the counties are all opening up for in-person showings. It was literally like, and I saw this on one of my other realtor friends' Facebook page. He likened it to being a little kid, where you've got the hose on and all of this water's coming out, everything's going great. You put the kink in it and it completely stops. And then you let go of the kink and it all just like starts rushing out and the hose is going everywhere. That's kind of how it feels right now. It's like everybody's like really jumping back in the saddle. I've gotten, more contracts and calls in the last week than, the whole month of April pretty much. So people are definitely, raring to get back in here in the Denver market. Like I said, we're blessed to be in a market that people want to live in. I imagine like we might even get some more influx of people that maybe don't want to live in New York anymore or LA. And the fact that our inventory was already so incredibly low, has kept our values. And it's not like the last recession, where homeowners had no equity because they had negative AM loans and they had faulty appraisals and they had qualified based on no income verification at all. So there's real equity, here in Colorado that's going to keep it strong. Like I said, some of it we're just going to have to see what happens with, what is the real unemployment rate going to be once everything has settled down. But fortunately, in the Denver market, we are diversified. There are a lot of different industries. And certainly, some of them have gotten hit really hard with the restaurants and whatnot. But we have enough diversity. We have low inventory. We have low interest rates. Prices have held their ground. So, I certainly think that there could be a little bit of this going on through the rest of the year. Some of that depends on how much the virus does or doesn't come back, depends on where the unemployment rate shakes out. It also depends on when people that have taken the deferrals on their payments on their mortgages, which is more homeowners, not so much investors. But some of those deferrals, which are not forbearances, you actually have to make those payments. And some of the programs that those homeowners took end in 6 months, and then in 6 months they have to make higher payments or even double payments. So that will negatively impact a part of the population as well. So I don't feel like we're going to have as solid of a year as last year, but I certainly see a lot of hope already and activity in this market, and I feel like we're going to pull through it well.
Mm-hmm. Yeah, our inventory is still so low, and things are selling really, really quickly right out of the gate. So that was good to see. Another question I had for you, do you have your own investment properties, and is there any advice that you would give to a first-time investor?
Yeah, certainly. I don't have anything currently, but I have invested a lot over the years. Once the inventory did start getting really low again, which it has been for quite some time, I stopped doing my own fix and flip investing just because then I was like competing against my own clients who I want to do loans for. My business is really making loans. So I didn't want to be like cutting off my nose to spite my face when we're all competing over the same property. But yes, I have, particularly like after the last recession, I did a lot. I did in the Highlands, I've done University Hills, I've done Whittier, North Park Hill, kind of all the usual places that you hear fix and flipping going on. And I also invested in rental properties in Phoenix. I would say on the fix and flip side for a new investor, it's not just about what you do to the property, it's about the whole neighborhood itself. So really pay attention to what's around your property. And it doesn't mean that these things make a property not doable, but it means you're going to have to offer a lower price when you're buying it, such as if your property backs up to a commercial area, if your property's on a really busy street, if your property's next to a neighbor that has, 100 garden gnomes in their yard, if it's a real dump next door and there's no sign of that seller selling, and so that's what your buyer is going to come in, live next to, that's going to impact your marketability and your value. So you've got to be offering lower prices when you're getting into a situation like that. Even for myself, like I did this property in the Highlands, which everybody knows is super, super hot neighborhood. And it backed right up to the Highlands Square. And so you could literally like walk out the backyard and be at Anthony's Pizza. It was right on Moncrief. And at first I thought, oh, well, that's like super cool. Like, people that want to live in the Highlands, they want to take advantage of all of that stuff that's right there on the square. But when you back right up to that, it was a negative even in that area, because the master bedroom, which we did beautifully, but it was on the second level, And all of that noise from the Highland Square, all of that activity, you can hear all of that in your master bedroom. So it reduced my value, not increased it, even in a super hot neighborhood. So yeah, definitely, you know, as a first-time investor, really learn the neighborhoods that you're planning on investing in and pay attention to what's around you, not just what you're doing to that particular property.
Right. Yeah. And I think one thing I would add to that too is to not over update or upgrade, because sometimes you're like, oh, I'm going to go full board, I'm going to do all this cool stuff. But so if you are working with a cool realtor like me, you know, I would take the time to preview other properties in the area with my clients so that they kind of know, okay, so this is more, you know, high end or mid-level type of upgrades and that kind of thing, so that you know what to invest. So
yeah. And not just to, you know, shamelessly plug you, but I mean, it's so true that working with a realtor that's done this themselves is going to get you so much more of a different result than working with an agent that doesn't specialize in fix and flip. So, you know, when you've been in the trenches and done it yourself, you can be like, yeah, here's what I learned. Like, don't do that. Here's what you need to do. Yeah.
Right. Thank you. Yeah. Okay. Well, I think I covered all of my questions. Did you have anything else to add or anything you wanted to ask?
Oh, did you have a question?
Oh, I see the hand waving.
Or was that just a buy?
Yeah.
I'm not sure.
You were talking about different ways that you can finance getting into.
Uh-oh.
And one of the ways you talked about was to use the equity in your current home. So that would be something that you would have to go and do first, because that's not something you take care of. That's just one option to bring money to you, correct?
Right. So
Okay.
an option that clients do sometimes use is getting a home equity line from their bank or their credit union to then be able to use that as the down payment for their fix and flips. We also do something called cross collateralization that I mentioned, that if you're not able to get a home equity line of credit, we could possibly look at using equity in that property as the down payment for the fix and flip, where we have a lien on the fix and flip that you're buying and then also on the other property. But I would recommend trying to get the HELOC first, just because the rates are so low on those, and then also they stay in place as a line of credit. Did that make sense?
Yeah, the home equity line of credit, gosh, those are based on the prime rate. So rates for that are super low right now.
Yeah.
Yeah. But they're also, I did talk to, so you can only get those done at certain banks. Not everybody does those.
True.
And the contact that I have is at UMB, and she said the only thing is they're taking 45 to 60 days to get done. So that's a bummer, but so if it's something that you're thinking about doing in the future, you know, getting a home equity line now would, in preparation, would be good. So yeah. Well, cool. Well, I think that's it then. Thank you guys all so much for coming, and
thank you so much.
Yeah, let us know if you have any other questions. You can contact us.
Anytime.
Oh, Brenton, I'm
Aw.
sorry. I think I did these controls wrong. Did you have a question?
Right, yeah, just real quick. First of all, thank you, ladies, for your time. I really appreciate you taking Friday night out. So, two questions, actually, one for each of you. Jennifer, do you use any spreadsheets analyzing properties on fix and flips and fix and holds? Do you have any programs or anything you use to analyze cash flow and expenses, or do you just kind of chart it out?
Yeah, so I do have that return on investment worksheet that I kind of broke out in the screenshots. So it's in an Excel format so that you can, you know, enter the different numbers, property costs, all of that, and it'll calculate it for each specific property. That's more for, so from my perspective, like me advising my clients, I feel like fix and holds are really where it's at, because if if each person could have, 2 to 5 properties and you hold on to those for 10 years, that's going to be a really nice retirement in 10 years. So,
I agree.
yeah, so I don't have
I'm a
anything.
big hold guy. I don't, we do a lot of fix and hold, but mainly in apartments.
Okay. Yeah.
We do large scale apartments.
Oh,
So,
nice.
yeah, so we have almost 900 apartment units that we.
Wow, awesome.
Wow, that is awesome. Yeah, that would be
leads
a great
me to
place
the
to be.
next question is, Kim, what do you offer as far as multifamily financing? What do rates and terms look like? I know with a lot of commercial financing, it's hard to find fixed rate financing. But what kind of offerings do you guys have?
Yeah, sure. And keep in mind, we are just a short-term lender on everything. I'm not a long-term lender, but I certainly also have resources on the long-term for commercial properties. So I generally come into play when you're buying a property that's pretty distressed and it's just not, you don't have the tenants in there, it's a mess. You need to get it up to rental quality and get some tenants in there to be able to get that long-term financing.
Right.
And so depending on the project, I mean, if it's like a small, like only 8 units, we might be as little as 10% down. Generally, when we're getting into some larger units, we'll be 20% down. And I am more of a smaller lender. So like most of my loans are like 4 million and under. We've done some apartment complexes in Aurora and in Denver, but I'm not like a large scale lender, but I certainly, have just been in the industry for such a long time, then you might even know some of the same players that I could recommend to you, if you're looking.
Well, I'm a recent transplant from California, so all of our investments are in California.
Oh, sure. Yep.
Yeah.
And we do have a California arm. I can connect you to our guys that are on the ground there. They're super knowledgeable because they live there. So they'd be good resources for you on that side of things too, which I'm happy to connect you on.
Yeah, that would be great because the stuff we're looking at is probably 10, 20, $30 million range.
Sure. Yep.
Yeah.
Probably be best if I connect you to my California guys.
That would be perfect. Yeah, we just closed 120 unit in December.
Awesome.
So, yeah.
Well,
that's a big rehab project, let me tell you.
yeah.
That's awesome.
That's like a year project.
Yeah, no kidding.
Mm.
Cool. All right.
Well,
thank you so much.
Thanks for having me.
Yeah, you're welcome. I hope everybody has a great weekend, and thanks for attending. And I'll send out a follow-up email through Eventbrite or whatever with the recording and then some of the resources that we talked about. All right, guys.
Hope to see you in person.
Yeah.
Thank you.
Bye.
Bye-bye.